Good morning, everyone. This is John Cogan. I'm the CEO of Performative, the online community for corporate finance, accounting, treasury, and related professionals. First, I would like to welcome everyone to today's webinar entitled Key Elements of a Successful Hedge Program. This session explores the underlying concepts of currency risk and hedging of that risk. We will explore the geography of economic and accounting risks in your financial statements, provide insight into examining your risk horizon, and explain when and how basic derivatives protect corporations from those exposures. This conversation will then expand to discuss when companies generally start into hedging, what key controls should be in place, and why hedge results won't be perfect. A few items before we get started today. Certainly I'd like to start off by thanking Hedge Trackers. Through their generous support, we are able to hold events such as this at no cost to our users, which is absolutely wonderful. They have also been so kind as to provide today's one of today's two speakers, who is absolutely a leader in her field, and we have two speakers on today's webinar, and we look forward to hearing from both of them shortly. So I'd like to welcome folks for whom this is your first Performative event. Performative is the largest and fastest growing online resource for corporate finance, treasury, and accounting professionals. Well over 500,000 of those professionals are in touch with us every month. And it's a wonderful online spot for learning from your peers. That's what we are about. It's all completely free, like this morning's event, and noise-free, so no ads on the site, no self-promotion allowed. Please check us out at performative.com. Next up, a few notes on this morning's event. A link to today's presentation is actually already out on the Performative site. Simply go to performative.com/resources, and it will be the top item there. We will post a video of this webinar in very short order as well. Those who would like CPE credits today will need to answer the polling questions that are presented. Most folks have already pre-registered for CPE credit, but if you haven't, don't worry. Take the polls. And if you have any questions at all, please contact Tanya Walsh. You can see her email address right there on the screen. Please ask questions on today's topic. We have wonderful content, fantastic speakers, truly global leaders. But that doesn't mean they're going to answer everything. And in anticipation of any unanswered questions, please note in your GoToWebinar control panel there is a section called Questions. Feel free to ask questions at any time, and we will do our best to get to them when we get to the Q&A section of this morning's event, which will be the last 10 to 15 minutes. So don't be shy. After you hop off of today's webinar, you will be asked to take a short survey. It's actually part of the GoToWebinar tool. So when we turn off the webinar, you will be prompted to take a survey. It literally takes about 1 minute. We would greatly appreciate your taking that 1 minute. We want to know what we can do better, A, and B. On that survey, we make it really easy for you to ask us to connect with either of today's speakers. It's a click of a mouse away, and then we will directly introduce you via email, and you can get any further questions answered directly by the experts we'll have online. So that's the housekeeping for today's event. We're going to be talking about a number of elements around currency risk and hedging of that risk today. We're certain that by the time we're through with this morning's program, you'll know a lot more about what these programs are for, how they work, and how you should be leveraging them at your company. So to help us, I would like to first introduce Helen Kane, who is the founder and president of Hedge Trackers. Helen founded Hedge Trackers in 2000, and since that time has worked with hundreds of corporations and financial institutions to implement or refine GAAP-compliant hedge programs. Helen's technical knowledge has been codified into Hedge Trackers' derivative accounting software and outsourcing services. She has chaired both the East and West Coast annual derivative accounting conferences sponsored by CPE Inc. since their inception in 2004, and is a frequent guest speaker at technical treasury and accounting forums. During the 90s, she led the Deloitte & Touche Silicon Valley risk management practice focused on hedge program development for multinational corporations. Prior to Deloitte, Helen served in treasury, finance, and accounting roles for multinational companies. And with that, Helen, welcome this morning, and please take it away.
Thank you, and thanks for the opportunity to talk about derivative accounting with your with your listeners. I'm going to go ahead and jump in. We have a lot to cover this morning. We're going to kick off really kind of talking about what you can expect out of a hedge program, what hedge programs can and should appropriately be doing for corporates. We're not talking about using derivatives here in a speculative manner, but really as hedges, really as protective devices for your company. We'll talk specifically about what type of protection the hedge program ought to be bringing, what kind of objectives you might be considering for a hedge program, and really kind of introduce very briefly the two key products used to hedge exposures. Then I'm going to turn it over to Walt Boileau, who will be talking about communicating hedge effectiveness up to management. So I'm going to go ahead and kick off with really kind of talking with you about what hedging can do and what hedging cannot do. And I'm going to start with what it cannot do, because I think a lot of times people have false expectations with regard to what hedge programs can do. First off, a program where you are programmatically protecting your financial statements never guarantees the best rate, that you're going to be locking in your revenues at the top and your costs at the bottom of the market. So that is one thing we cannot promise in a hedge program. Anyone that can promise that, trust me, won't be working for you. They'll be out there very wealthy on the beach. So the hedge program can't guarantee the best rate. It can't fix bad forecasting. It's very good at locking in values that you've identified as exposures, but to the degree you have a bad forecast, you're going to have a bad hedge. Also, we can't protect a plan or a forecast rate that isn't a market rate at the point in time that the hedge is executed. So generally, the establishment of a plan or forecast rate, if you want that protected, needs to coincide with the timing of the hedge program. And then generally, folks are always hoping that when they're hedging their remeasurement gains and losses, that that hedge activity will return a zero to the foreign exchange gain or loss line, and frankly, not possible, just because of some of the differences between exposures and hedge instruments, and we'll address those later in the program. So let's jump now a little bit to what a hedge program can do. Really, hedge programs are very effective at protecting a corporation's operating margin. We can protect margin for the low margin, high volume activity, for the high dollar, low volume activity. We can also, with a hedge program, provide revenue or cost predictability. We can protect cash flows for cash coming back, lock in the value of that, in our case, US dollar cash coming back into the company. And in some cases, protect the the P&L value of those dollars coming back. Now you'll notice on this slide where I've indicated that we can protect earnings and we can protect margin. There's some caveats there. First, we would need to apply for and qualify for special hedge accounting, and that depends often on the structure of our company, the functional currency, etc. But in general, hedging can protect margin and help us protect earnings. It can also help us reduce volatility in the FX gain or loss line. I wanted to kind of kick off by talking about, before we get into more details on and how we would protect our margin and our FX gains and losses, is talking about the two instruments that are generally used to hedge. The first one are options, and although most of us think of options as something where we want to make money, these options we're looking at as an insurance product. We have an exposure, and given the volatility in currencies today, I think you should think of options as trying to insure a 16-year-old driver. And I don't know how many of you out there have been through the 16-year-old drivers, but I'm heading into another one, and you know, you pay a lot for insurance for good reason. You need protection. So options are really kind of an insurance. You're going to pay an upfront fee, and if bad things happen, you will be compensated. Forward contracts have a little different structure where they're really kind of helping you commit today to a rate at which you're going to exchange currency. And we hear a lot from individuals that they're concerned that, you know, if they're executing forward contracts, that the banks are going to be, you know, making a lot of money on them or something. And what I wanted to do is kind of just a quick visual here to show you that, you know, the banks do make a spread when you convert currency. And basically, you can wait until you receive or until it's time for you to pay that foreign currency for the bank to make the spread. By the same token, they could make that spread, that same spread, earlier in the process, and you could be protected early in the process if you were to put that hedge on at the point it becomes a receivable or a payable on your books. At this point, you'd be protecting that FX gain or loss line. But again, the very same spread, the very same you know, cost to you is going to occur if you move the timing of fixing that conversion rate back to the point in time that you made a commitment for the purchase, or you set up your budget or forecast or established your price list. So a forward contract is merely committing to the conversion rate that you're going to be experiencing in the future, but you're actually committing to that rate earlier in the day. So basically, we look at it as committing to today's spot rate for a future conversion. Okay, so let's look then, given the types of instruments that we have, to a couple of different exposure scenarios. The most likely scenario that we would expect the callers to have would be that you would have revenue in one currency, and in this example that I'm going to be looking at, we're going to be looking at revenue in US dollars, and cost in a second currency. And so for our example here, I'm going to use euro. And I set a little example up just to kind of show you, and I'm kind of starting out with a tight margin assumption. We have companies that have very small margins, companies with much larger margins, and how they approach the problem is different based on the amount of margin that's in the transaction. So if we look at this case, I have revenue of $134, and my cost assumption when I contracted with my suppliers that the 100 euro were going to cost me about $130, and that would give me about a 3% margin. Well, let me kind of give you a little view of what's happened with euro over the last year. Oh, I went too fast there. The euro has been very volatile. We've seen extreme movements in the euro. It's been as high as 145. It's been as low as 119, 120. So that margin that we were looking at has really kind of moved. I tried to put together here a little pictorial for you. Here's where I've identified the 3% up and the 3% down line. So all of the data points that are beyond these 3% line indicate, points in time where I will have either doubled my margin or, unfortunately, substantially eliminated my margin. In fact, I presented a slide here to kind of give you some insight on what would have happened to my margin if I did not hedge those euro costs, and I just let myself wait until the payable for me to experience this. So go ahead and take a look of what happened to my margin when I looked specifically at $134 in revenue and $100 of cost. And you can see that I spent a lot of time in severely negative margin territory. So really, hedging is about protecting that margin and really kind of aligning the point in time when you're committing to the exchange rate to the point in time when you're exposing your margin. So what would be a standard response for a company who has a scenario where they've fixed their revenues in one currency and they've fixed their cost in another currency? Well, this first hedge response slide really talks to a tight margin scenario like we just looked at. And generally what we would expect would be for that company to go ahead and execute forward contracts. The forward contract fixes the cost and the revenue in the same currency, thereby fixing the margin percent. Options, which are great conservative instruments, would not really be viable for a tight margin scenario because the premiums are so expensive. We would expect the premium to be running somewhere between 3 and 5%, and that would totally eliminate our margin and therefore making the business not viable. So generally we're going to be looking to forward contracts where we're going to fix the revenue and the cost in the same currency, protecting our margin percent. Now there are always risks associated with hedging, and you'll find consistently through this program that poor information, in this case poor information on the number of widgets that I might need to buy, poor information is going to result in poor hedging. And I'm going to either create an exposure by having too many forward contracts, or I'll leave margin exposed by being underhedged. There's also some risks associated with the timing of the hedge not aligning with the timing of the fixing. So if I were to go ahead and when I'm contracting with my euro supplier for widgets at 100 euro, if I'm not locking in that euro exchange rate at that time, and I'm waiting 3 or 4 weeks, I can have a substantial margin erosion in that time frame. Now, if I had a higher margin than that 3% and I had a little bit more flexibility, let's say I had a kind of a high dollar, low volume type product, option contracts, again, are really the most conservative, however, the most expensive instrument. I'd need to be willing to give up 3 to 5%, and I've noted there on the slide based on the driving record of the currency. So right now we're talking about a 16-year-old with a DUI. It's getting pretty pricey to kind of protect ourselves from movements in the euro because they've had a few incidences in their most recent driving career. If I'm confident of the sale, I just want to lock in the revenue or the cost of my foreign currency denominated revenue or sale, then I might be just as happy going in and executing a forward contract at the current levels. So again, an option would provide a floor on my revenue value or a cap on my foreign currency costs, where the forward contract really just locks in where rates are today so that when I actually execute that conversion, when I exchange currencies at the end of the day and I recognize those values in my financial statements, I will have preserved the margin that I expected at the point in time that I executed the hedge. The risks, again here, the risks are, do I have good data? Do I know, precisely the notional amount that I need to hedge? Generally, we would expect if you were very highly confident of your numbers that you would be out there hedging 100% of your exposure, to the degree that there is some risk in the number, to the degree that you're not exactly sure of the volumes, we would expect to see decreasing proportions of the exposure hedged, as we move out in time. Now, sometimes we don't actually have a specific transaction. We don't have a specific target in mind with respect to margins because we are hedging maybe an ongoing revenue stream in euro or an ongoing expense stream. We see this a lot with foreign subsidiaries where we have ongoing operating expenses. For example, I might be have an R&D center in India, and I know that I'm just going to have rupee expenses coming in, on a pretty consistent basis. And what I'd really like to know at this point is, what are my costs going to be in US dollars? What's going to be running through my financial statements? And this is the predictability that a hedge program can bring also, because what we can do is, rather than waiting until we actually record the payroll accruals and watch them come through consolidation at whatever our income statement rate happens to be for the month, we can go ahead and we can record those, with hedge accounting, we can go ahead and record those expenses at the hedged rate. That brings predictability into those operating expenses, and we can basically tell management precisely what rate expenses or ongoing revenues will be recorded at in our financial statements in the coming periods. So what's our kind of hedge response here? Again, we can look to forward contracts or options. The forward contracts, again, are going to fix the value of that revenue or expense in our currency. And again, we would hedge that amount based on confidence. My experience is that our confidence in expenses is always higher than our confidence in the revenue forecast. So generally, we would see people hedging a higher proportion of their expenses than the proposed revenues that they might see. Again, options are a great and a conservative instrument. An option, you know precisely what your cost will be, and you know that you will never experience those hedged revenues at at an exchange rate lower than you've locked in, or those expenses at a cost higher than you've locked in. Again, the risks associated even with these instruments are that poor data. If you have a bad revenue forecast and you execute a hedge against that, you'll find yourself over or under hedged and not delivering precisely the number that you were hoping. And also, you may, we often find kind of another risk in this predictability is that you might be misaligning kind of the hedging, the timing of the hedging with your budgeting or your forecasting timing. So that's one of the things that you really kind of want to work in coordinating your hedge efforts with your FP&A and financial forecasting efforts. I wanted to kind of share with you this this little graphic, which basically is showing you how a company would experience exchange rates without a hedge program, without trying to lock in this predictability of expenses, and contrast that if they had the hedge program. Basically what you would see is that rather than experiencing euro at 155 in Q3 of 07, this particular company, by hedging, would see 155 coming. They would have that timing and opportunity to plan for and know that euro was coming in at 155. It gives them visibility. Instead of saying, oh my gosh, euro's at 155, that's either great news because it's revenue or really bad news because I'm hedging expenses. It gives you the opportunity to say, in 2 quarters, in 3 quarters, I will be experiencing euro at this rate. What plans do I need to make? Do I have to look at my costs around the organization? Do I have an extra margin that I'll be able to take advantage of? It really injects visibility into what's going on with currency in a company's financial statements and allows the company to plan. The very last item that I wanted to talk about was the objective of really reducing the earnings volatility associated with the remeasurement of monetary assets and liabilities. If you had 100 euro of receivables in cash, 10 euro of payables, the net of that number is required at every balance sheet date to be revalued into your functional currency at the end of the period, creating remeasurement gains and losses in the FX gain or loss line. The standard response to that would be to use forward contracts that would create an offsetting liability. So if you had a receivable or cash, you would then sell the currency that you had the receivable or cash in, and then turn around and buy the currency that you're trying to exchange that risk into. So in our example of having that 90 euro position, we would sell 90 euro and buy US dollars. For those of you that are accountants, you can look at that contract. The sale part of that contract basically creates a liability in currency A that balances the asset in that we have naturally. And then we synthetically convert that combination of the 90 euro asset position with this liability, synthetic liability that we've got, so we have no euro exposure, and have converted that into a dollar position. Again, the risks, poor data, the timing of the information when we actually find out we have receivables or payables and can get the hedge on. And then occasionally for some currencies, the cost of covering that exposure really exceeds the value of the protection. So there are other issues that can impact the performance of that program. With that, I'm going to turn it back over to John. I believe he has a polling question, and then let Walt talk to you a little bit more about how you then turn around and report on the performance of that program.
Great. Thank you very much. That was wonderful, Helen, and great information. So folks will notice that I've gone ahead and popped the first polling question out on the screen. Now, please note that this is not required, and if it's only required if you're interested in CPE credit, otherwise not. But even if you're not here for CPE credit, we'd love to know where your company is with regards to this question and what your challenges are. And we will actually revisit the results of this poll a little later in the program. So everyone will get a chance to kind of see where they stand relative to everyone else. And this is all anonymized, by the way, so don't worry about that. And I'll make note while we let the last few seconds elapse here. Please feel free to ask questions at any point in time during today's program. They're queuing up here, and we'll do our best to get to them during the Q&A portion of our program today. So I'm going to go ahead and close down that polling question for now. We're going to have one more polling question later. And at this point, I'd like to go ahead and introduce and, of course, welcome Walter Boileau. He is the VP and Corporate Treasurer at Polycom, Inc., which position he has held since 2009. Walter has over 25 years' experience in finance and treasury. Prior to Polycom, he served as the VP and Corporate Treasurer at Sanmina SCI Corporation, the Assistant Treasurer at Hexcel Corporation, and served in various roles at Lockheed and Pacific Bell. And with that, Walter, welcome today, and please go ahead and take it away.
Thanks, John. Appreciate the opportunity to speak here today. Worked with Helen for a number of years, and have, I think, in counting on my way over here, worked for about 14 CFOs in my career, and have always found each one to be a little bit different in terms of their understanding of FX and what's important to them and what's not. So today I'm going to try to touch base a little bit on how me and my team have historically tried to communicate what the program is supposed to be doing and what they can expect out of the program. So typically with a CFO, you have to be very diplomatic and be somewhat an educator at the same time that you're explaining how FX can impact the financials. Talking first about the cash flow hedging side, cash flow is difficult because the gains and losses associated with the hedges is all typically that the CFO will see and not the underlying gain loss that's buried in the margin. Particularly if you're a manufacturing company, you can have FX buried even within the inventory components of purchase price variance and invoice pricing variance, and it gets very complicated to break that out to show that your hedge loss is actually offsetting an underlying gain or vice versa. So it takes a lot of time to really get them comfortable that the program is adding value, and that's the key thing that you want them to understand. And in order to measure the success of the hedging program, you need to be able to understand how FX impacts, both your cash flow and your balance sheet. And it's not always easy to spot the things that create variances because they could be related to things like inconsistent accounting between regions, input errors, even the basic complexity of following a transaction through the consolidation process. So, typically management knows that hedging is important, but isn't familiar with the limitations of hedging, including, not even being able to hedge 100% of the exposure, or what I found recently is not being able to hedge retroactively, which has come up a little while back with a previous CFO late in the quarter where FX rates were moving against us, and literally for a week or two at the end of the quarter, the customers decided to hold on buying because the rates were so against them and wait till numbers reset with a new PO the following quarter, and we were asked to find a solution to somehow make FX not a problem, and it's a little hard to do that late in the game. The example that I've listed here of losing on cash flow hedges being a positive is sort of getting at the heart of the difficulty in communicating what is good and what is not. Since you're not hedging 100% of the cash flow exposure, some portion will be exposed. And if your underlier is, well, let's put it this way, if your hedge is creating a loss, then the underlier must be creating a gain. If your hedge is not fully offsetting the underlier, then that should overall be positive. And then ultimately, when you go to put in a new hedge again, if the rates are moving in that direction, presumably that will continue to be a positive for your underlier. So again, the logic of, my hedge is losing money, so that must not be good is exactly the opposite. It's typically the right answer. So that's just to show you the nuances of getting management comfortable. With respect to the limitations of cash flow hedging, Treasury and FP&A need to be attached at the hip. Helen sort of hinted at that earlier. FP&A is setting the P&L targets based on forecasted FX rates they receive from Treasury. FP&A is also constantly updating their P&L forecasts based on the latest estimates of FX rates, which we typically are including in those estimates are forward rates based on the hedges we have in place. So it's a blended rate. Treasury is also hedging based on the P&L forecast we receive from FP&A and Ops Finance in each of those currencies. So we both rely significantly on each other to be successful. In order to qualify for hedge accounting treatment, Helen sort of hinted at that earlier, there are a number of criteria. Again, the idea of hedge accounting being to allow you to treat both the hedge and the underlier as one and reduce the ultimate volatility to the P&L. But in order to get that kind of treatment, you might decide that you're going to hedge gross revenue or expense or income, and depending on what you're hedging, that's going to hit a different line of the P&L. Also, depending on whether you are including or excluding the time value in your cash flow hedging will determine whether your forward points are getting booked either in revenue and OPEX or in other income expense. Also, with respect to the accounting requirements, you'll have to document your hedges within 3 days of hedging and have done it both prospectively and retrospectively on a regression effective basis to show that the hedges are qualified. So there are a number of things that you've got to do to achieve this clean treatment of hedging. With respect to functional currency, a lot of people think that that's just an accounting rule and it is what it is, but the reality is that it's not as black and white as one might think, and there's although there are a number of rules that you're reviewing, there are certainly some gray areas, and it's really important that Treasury has a strong hand in helping accounting get to the right answer from a Treasury perspective and hedging perspective, because it's going to be difficult to optimize the hedging program if you've got the wrong functional currency. For example, if you have Euro revenue and USD costs in a Euro functional entity, excuse me, and you're not going to be in a position to hedge your Euro revenue directly. You can hedge it via proxy by hedging the non-functional currency costs, or if it's an interco sale, by hedging the exposure on another subsidiary's P&L, to the extent that that's a different functional currency. But ideally, what you'd like to have is that the functional currency of all of your subsidiaries being that of the reporting currency. Typically that's USD, so that you can achieve both economic and accounting hedging, and that's the ideal. You really don't want to just be hedging for accounting purposes only if you can optimize the program and actually get accounting and economic benefit. With respect to settling payments, whether it be gross versus net, even though the economics are the same, you could confuse management, which is what I was sort of getting at here with perception of a payout killing a fledgling program. Management may not understand that a payout isn't necessarily a bad thing. It's just that if it's broken into two pieces versus netted, all of a sudden it looks like it could be a problem. But just as I mentioned earlier, hedging can create losses and still be positive. So let's go to the next page. Excuse me, communicating with management. So here we're getting into, what exactly are we reporting on with respect to margin and operating expense, and how does that get measured? Now, often it's good for management to understand how the forecasted FX rate compares to the planned FX rate and to explain those differences, and this will help them understand the nuances of hedging and appreciate the results that you achieve. Hedging components of the P&L are done for various reasons. In higher margin businesses, like the company I'm at now, typically hedging is done to provide forecast reliability. Management wants to be able to forecast with a high degree of confidence what that revenue will be over the next 12 months. And in a lower margin business like the electronic manufacturing services company I was at before this, our hedging was done primarily to protect margin, because margins are very thin. I think we had a 2 or 3% operating margin. And a lot of the risk is tied to how the contracts with each of the customers are written, because the pricing and the resetting of pricing typically spells out how the foreign exchange rates will be calculated, which can have a significant impact on the profitability of that program. I've seen contracts that are completely in favor of the customer where the FX rate resets once a year or once a contract, and it's just impossible to hedge a situation like that. When you get that far out, you have to get back into the market, and now you're no longer aligned with the contract rate. So we spent a lot of time on contract negotiations in my last company trying to get the best pricing we could, but we weren't as focused on what was the revenue going to be from a foreign exchange impact perspective. You should focus on comparing your achieved or actual rate versus your target rate, and not the amounts, because otherwise management will lose sight of the purpose of your hedging. Variances to that target rate can occur for many reasons. The most common is because of the forecasted mix of currencies and amounts being changed from what was originally planned. This can cause one to be either over or under hedged and change the weighted average hedge rate. If one is significantly overhedged to the forecast, it can cause one to have to carry over the unused hedge into the next quarter, where it has to be used within a short period of time to maintain program effectiveness. So every time this kind of variance occurs, it completely disrupts the forecasted FX rate that you had planned. Also, it's difficult to assess how accurate the forecast you receive will be. So as Helen mentioned, particularly if you're forecasting revenue you're going to be more conservative. And so your confidence factor is not going to be as high, which leaves more of your exposure unhedged and therefore gives you more volatility in the rate that you're forecasting versus, say, hedging expenses or costs, which are more predictable. Okay. So here's an example of the format we use to show the variances that we identify in the cash flow hedging program. On the left is there's three different rates that we've called out here. This weighted average rate is the actual accounting rate that is published for purposes of booking all the entries and is, in our case, based on the weighted average Bloomberg published closing rates for each day of the period. That versus the blended hedge rate, which is a combination of forecasted rates for the unhedged component plus our hedge rates for the hedged component. And in our case, in our program, we're hedging out 4 quarters, and we typically increase the amount that we're hedging the closer we get to the quarter we're hedging. So the furthest out quarter we'll hedge 60%, and the furthest in quarter we might hedge 80%. So we're layering on additional hedges as we get closer to that quarter because we've got a higher degree of confidence in the forecast that we're going to achieve. You know, there are different strategies of hedging the cash flow, though. You know, some hedge the whole year at once, maybe on a month-by-month basis. Some ladder it out a quarter at a time. But the end result, as Helen had shown in some of her graphs, is that the ultimate goal is a smoothing of the impact of the FX rate. It will not provide ultimate economic protection unless you could hedge indefinitely with perfect information, and that's not possible. So you're always going to find yourself in a point where you're going to be resetting to the market again. But it does allow you that longer-term visibility and a smoothing effect of your FX rate volatility. All of this is compared to the target rate, which is the quarterly target rate I show at the third line there for each of these currencies. And that target rate is, for us, typically we develop one for our annual operating plan, but we also update it quarterly for the quarter we're in. A couple of things you'll notice in this layout is that the cash flow hedging program provides predictability. And you can see that because the hedge rate is typically closer to the target rate than the average rate. Whoops. Oh, and notice that the focus in the report is on rates, not dollar gains, losses, if you will. Also, the forecasted hedge rate is indicative of the headwind or tailwind the company is facing when compared to the target rate. So, for example, a Q2 euro shows favorable hedge for a revenue exposure, let's say, versus the target or the weighted average rate. And it's a little bit confusing here because I'm showing an actual rate in a forecasted mode, but what I did is added the actual rates that we've experienced here so that one could see, you know, or put in indicative actual rates so one could see how the two compare. But realistically, those would only show up as you have actuals. On the next slide. So hedging the P&L, a lot of it comes down to making sure that management is on the same page with you regarding expectations. The objectives need to be qualified for things beyond your control, line changes in the forecast that I mentioned earlier. And the forecasted hedge rates need to be built into the forecast that FP&A uses when building the annual plan and developing the quarterly forecast. This helps FP&A become aware of the importance of the FX rates and helps them improve visibility, provide visibility to management when the rate is different from the forecasted in the annual plan. It also puts more responsibility on FP&A to stay integrated with Treasury with respect to the hedging program and gives them an appreciation of the need to keep Treasury informed of any changes to the plan. And it ensures that the hedge objectives are aligned with the expense goals. The other area of hedging is balance sheet hedging, and you know, the FX gain loss line sits in other income expense below the line. And it's important here again to give management an understanding of the impact the hedging program is having on that FX gain loss line. Often showing what it would have been with and without hedging is one way of doing that, and one needs to emphasize the reduction in volatility, not whether or not there was a gain or a loss. Your goal, as I've always said, is to get as close to forward points or 0 plus forward points as possible. So, you know, what does that mean? Well, I think the first thing to managing a good balance sheet hedging program is to really understand it. And the way to do that is to dig down deep into what is driving the variances one sees in the monthly financials. There are a number of things that we have learned over time that are related to variances and become areas that you have to focus in on and determine what portion of that you can control and manage. Treasury, you know, needs to be an educator not only of FP&A but tax and ops finance as well. And it's actually necessary that one is, you know, able to identify, for example, forecast variances. It's probably the hardest one to eliminate because it's not completely within your control. And, you know, you can do sanity checks, but in the end, FP&A and ops finance are the ones that are driving the underlying forecast. They typically, though, are not used to forecasting balance sheet. They're used to forecasting a P&L. So Treasury ends up training them on how to forecast the significance of, you know, of missing it, but it's done typically by taking that prior month monetary net exposure, balance sheet exposure, and then looking at the P&L forecast by currency to move that balance sheet forward to a forecasted position. Again, this is something that FP&A really, you know, they're so P&L focused, they typically, it's foreign to them to think about the balance sheet. So this is where a lot of time is spent in terms of educating them, getting them comfortable that this works, and then helping them understand why what they're giving you is relevant to the overall P&L. In addition, forecast variances can be caused by things like interco loans that have been created within the company and not identified before initiated or booked. So you could have, say, an interco loan created, and maybe one side of the loan is booking it in one currency and the other is booking in a different currency, and there's an exposure being created that you may not even be aware of or may not be appropriate. There's also situations where loans get settled before somebody finds out, and if you've already had a forecast that showed it outstanding, you could be completely exposed, either over or under hedge, depending on what that interco loan was doing. So very important to stay completely in tune and get finance to get familiar with keeping you apprised of changes that are significant to the balance sheet exposure.
Well, I would just interject on that point about the intercompanies is also keeping connected to tax, because it's frequently tax that, you know, for tax purposes is creating historically some of those intercompany balances.
Yes. With respect to forward points, a lot of times I've had CFOs say they want OIE to be 0, and that's just not realistic, because just to do a basic hedging program, you're going to have forward points, and they're not always going to be in your favor. So at a minimum, the CFO has to be comfortable that there will be some cost to hedging, and that's just, you know, part of doing business. With respect to unhedged exposures, we've seen this many times. Some exposures we are not hedged simply because either they're immaterial or we view them as immaterial based on amount, but then we find out they're material because of volatility, or because the cost of the hedge becomes cost prohibitive, and we've seen that most recently with things like the Brazilian real. As it relates to unhedgeable exposures, you know, some exposures are, you know, the the functional currency that the entity has versus the exposure, as I mentioned earlier, you may not be in a position to hedge it, or sometimes there's just not enough market activity to find liquidity in the market to put a hedge into that particular currency. In the case of balance sheets, you can have variances with respect to timing where you've got maybe a P&L rate that you've used for the balance sheet activity, excuse me, remeasurement, and that's the average rate versus the prior month balance sheet. Since the remeasurement is from the average rate to the current month balance sheet, and you can't align the hedge with the average rate. If you can convince accounting to use as your average, or your P&L rate, your prior month balance sheet rate, then you actually can get a complete alignment with the hedge. But even with that, you can still have variances if you're, say, using Bloomberg to establish the spot rate for accounting purposes on the last day of the period, instead of using the spot rate from your hedge that you put on that day. And we've seen volatility as much as a few percent in one day between when we put the hedge on and when we actually saw the accounting rate get locked down. Finally, Treasury adds, I think, the most value on OIE by simply weeding out garbage, areas that are put in that people book to OIE because nobody except Treasury is looking at it. With respect to managing the format of explaining variances within the balance sheet, here's a format that we've used, and typically we called out all the items I just talked to. We lay them out historically by quarter, and we also add comments about what drove some of those. And we also show an absolute value component of that just to give management a flavor of what the worst case scenario might have been if everything went against you versus how we ended up, to help them understand some of the value you're bringing to the table. So that's kind of maybe it's dwelled a little too long on some of the slides, but hopefully we got the main points across. Back to you, John.
I think you did. Thank you very much. So we are a little crunched here. I'm going to go ahead and launch the second poll. So we'll get moving on this quickly. I'll give a little less time for this, so folks can just go ahead and be prompt. Go ahead and ask your questions in the question control panel while we're waiting for this poll to be answered by folks. And we're probably only going to have time to get through a few of them, but I will work with Helen to see if we can't get some of these answered on performative at a later time, and hopefully bring that knowledge out to everyone who's on the webinar. So I'll go ahead and leave that poll open for another 10 seconds, and then we'll close it up and we'll take a look at the results of both of today's polls. So I'm going to go ahead and close it down at this point. Close, and then let's go ahead and revisit these real quickly. I'm going to push out the results of the first poll, which should be on your screen in just a moment. So what is the biggest challenge facing your hedge program? I guess we can probably ignore here Helen and Walt, folks who don't have a hedge program yet, but for those who do have a hedge program, it looks like knowing where to start, which is not surprising at all, is a major challenge. Helen, can you speak to these results and any insights you want to give folks on sitting on any of these data points?
Yeah, I think, interestingly enough, knowing where to start and staff expertise, kind of looking at the questions, almost could be lumped. Knowing where to start, frankly, is with the data. If you notice kind of in Walt's and my comments both, you really need to know and have in place a process for collecting the information associated with your exposure. So if that is, what contracts do you have, that are fixing values, and really kind of getting to the numbers. Getting from the numbers to execution of the transaction is a really, a slam dunk. That's very easy to do, and, frankly, your banks are standing by to facilitate your doing that. And then, then it comes into that expertise piece of, now how do we account for that? How do we communicate those results to management? And again, the biggest issue here, I have to tell you, what we face time and again is that the FX isn't intuitive. It's really something that needs to be learned. Really trying to communicate to management that it's good news to be losing money on your derivatives. Trying to communicate them the results, where it's not really our best, result could be we just lost a lot of money on these derivatives, doesn't go over well. So really kind of learning to communicate with them in terms of mitigating volatility and looking at gains and losses. So it's not surprising knowing where to start because, again, it's not intuitive. So know that you're not alone in finding this a rough place to start.
Yeah, some serious challenges there, and that whole communicating to management thing is challenging. So in the absence of time that we're facing here, I'm going to go ahead and hop right in to the next question that was asked, and I'm going to start with Walt on this one. How do you manage your hedge program? Spreadsheets. I can't say I'm horribly surprised. Walt, have you guys gone from spreadsheets to dedicated software, and what have you seen amongst your peers?
Yeah, I think it's a combination. It's hard to get completely away from spreadsheets, but I think what we've done is looked at ways to automate the process to reduce some of the input error risk and some of the administrative tasking. So we've in our case used FXall. We've used Capella to help us with the effectiveness testing of FAS 133 hedging, and we've integrated our spreadsheets with the ability to upload information into these programs to help reduce some of the inputting. But in the end, you're still going to need spreadsheets, and I'm not surprised by that answer.
Helen, are folks outsourcing this entirely these days? Is that becoming a more popular option?
We do a lot of outsourcing, but that's really at the back end. We do outsourcing in software, really at the back end of your hedge program for your accounting results. But I think there's a lot of work up front in the data collection. There are some softwares out there that help people identify and accumulate the exposure information for what's in your financials. Sometimes you can pull it through just from your ERP system reports, etc. But that was a pretty common, and generally it's a combination of spreadsheets are in there somewhere, I think, for everyone.
Mm-hmm. Gotcha. Okay, well, we're actually about a minute out from the end of our time, so we have a handful of questions here. I will work with the speakers and see if we can get these answered on Performative. And with that, and being respectful of everyone's time, I think we need to just move right along. Actually, we're not going to send you a follow-up survey, but rather after you leave this event, you will be presented and asked to take a survey, which will take all of a minute. In there, you can also request to be connected directly with either Helen or Walt, and we will help make that connection quickly and painlessly. If you have any questions about CPE credits, you can see the person to contact at the bottom of the page, Tanya Walsh, and her email address right there. We would love to thank Hedge Trackers for helping us make this great event possible. Lots of fantastic information, and of course for that, we have to thank Helen and Walter for your time and insight. Really appreciate it, both of you. Wonderfully presented, and there's an awful lot to learn here. So thanks for helping us all come up to speed a little bit more today.
Thank you, John.
Thank you.
You bet. Our pleasure. And with that, finally, we'd like to thank everyone for your valuable time and attention this morning. We appreciate you've got infinite other places to be spending your time, so joining us is wonderful. It's great to have you, and we hope to see you soon at another event or online at performative.com. And with that, I will go ahead and end this morning's webinar, and for everyone who's on the line, you will be presented with an option to take that quick survey. We greatly appreciate it. Thank you much. Bye now.